Why a good salary often leads to worse financial decisions. Have you ever noticed how the moment your salary improves, your finances somehow feel tighter instead of easier? Not because you're irresponsible, not because you're bad with money, but because something subtle changes the moment your income crosses a certain line. Let's walk through a familiar situation. Imagine a young professional in the US or Europe, mid-20s to early 30s. You land a good job. On paper, it looks solid. Let's say $75,000 a year in the US or the European equivalent. After taxes, healthcare, and social contributions, your monthly take-home lands around $4,300. At first, it feels like relief. Then reality starts filling the space. Rent or a mortgage takes $1,600 to $1,900. A car payment or lease, $450. Insurance, fuel, maintenance, another $250. Student loans or education debt, $300. Phones, subscriptions, utilities, $300. Before food, travel, or saving anything, you're already past $3,200. Nothing here feels excessive. In fact, most of it feels normal. This is where the problem hides. With a higher salary, decisions stop being framed as, "Is this necessary?" They become, "Can I afford the monthly payment?" That shift sounds harmless, but it's expensive. Let's take the car. Instead of a reliable used car for $12,000, you're offered a $38,000 vehicle at only $450 a month. It fits your income, it fits your peers, it fits the lifestyle you're now expected to live. But over 5 years, that single decision quietly costs over $50,000, including interest, insurance, and depreciation. Not because the car is bad, because the framing is. The same logic shows up with apartments, phones, furniture, travel, and credit cards. High earners don't overspend dramatically, they overspend smoothly. Everything arrives as a manageable monthly number carefully designed to feel safe inside a larger paycheck. The system rewards this thinking. Banks don't ask how resilient your finances are, they ask if your income can support the payment. Employers celebrate raises without addressing lifestyle pressure. Society quietly links income to visible upgrades. And psychologically, this is where things get tricky. A higher salary creates a sense of security that hasn't actually been earned yet. The brain treats income growth like wealth, even though nothing has been accumulated. So spending increases first. Saving is postponed to later when things stabilize. Except they rarely do, because once lifestyle rises, it becomes the new baseline. Going backward feels like failure, even when it's financially rational. This is why many people earning good money feel stuck for years. Not broke, just unable to move forward. No flexibility, no real buffer, no compounding working quietly in the background. And the long-term cost isn't just financial, it's optionality. A job change becomes risky, a break feels impossible, stress increases even with a strong income. Now here's the important shift. Financially intelligent people don't think in terms of what their salary allows them to buy. They think in terms of what their salary allows them to keep. They treat raises as a tool for margin, not upgrades. They delay lifestyle changes long enough to see where the money actually goes. They measure decisions in years, not months. Not because they're disciplined machines, but because they understand how easily comfort can consume future freedom. This isn't about deprivation, it's about timing. A good salary is powerful, but only if it creates space before it creates lifestyle. Once that space exists, better decisions follow naturally, not through guilt, through clarity. If this way of thinking felt useful, consider subscribing.